Hello and welcome to this lecture. This is to give you feedback on the quiz 2 that you recently wrote. It is to help you to understand what was expected from this quiz. And so when you get your script, your answer script, you'll be able to appreciate your performance and also to prepare you for the upcoming exams. So I'm going to use this set of questions. Question 1. Kumasi, an entity in Ghana, paid 763,600 for 80% of the 2 million equity share capital of Libreville, a foreign entity. Now, in going through this question, I want you to immediately pay attention to the currency. Kumasi paid Ghana cedi, 763,000 Ghana cedi, and paid for 80% of the 2 million equity share capital. The share capital of Libreville is 2 million Central Africa franc, which is the functional currency of Libreville. So the presentation currency of the parent Kumasi is Ghana cedi, and the functional currency of the subsidiary is Central African franc. The subsidiary was acquired on 1st January. Take note of date of acquisition. So it is 1st January 2020 when its retained earnings were 1.2. Again, take note of the currency. It's very important. Reporting date 31st December, and the retained earnings at 31st December, the reporting date is 1.6. Fair value were the same except for 800,000 of a property with 5 years remaining. Fair value of NCI is 1 million. Goodwill at the reporting date 50% impaired. The relevant exchange rates are given below. Calculate and translate the net asset at acquisition date and at reporting date. Calculate and translate the goodwill at acquisition date and at reporting date. And calculate the parent and NCI share of the translation gains and losses. So the beginning of this question is to recognize that you are dealing with the parent who acquired in Ghana cedi and subsidiary whose functional currency is CAF. It's important, therefore, to remember to set the net asset in the functional currency of the subsidiary. So the first thing to do is to determine the net asset in the functional currency of the subsidiary, which in this question is Central African franc. You will determine the opening net asset and the closing net asset in the functional currency. So this is where you write net asset at acquisition. So you have the acquisition date net asset and reporting date net asset. So this is your net asset format. So you have your share capital, retained earning, fair value adjustment, and a depreciation. This is your format, and it is in the functional currency of the subsidiary. It is very important. So your share capital in the functional currency. And in the question, that share capital is 2 million. So 2 million and 2 million. Your retained earning at acquisition retained earning at acquisition is 1.2 and at reporting is 1640. So 200 million 1640. So I am emphasizing that all these figures at this point is in the functional currency of the subsidiary. So let's see how this will play out. So here you can see that your net asset is set out in the functional currency of the subsidiary, Central African franc. And so your equity is 2 million at acquisition at reporting. Your retained earning is 1.2 at acquisition at reporting. You have a fair value on the property of 800 at acquisition and at reporting, with a depreciation, fair value depreciation adjustment at reporting of 160 because it's 800 divided by 5 at the reporting date. So your net asset at acquisition is 4 million. Your net asset at reporting is 4,280,000, 4.280. And so your post-acquisition profit is 280, all in the functional currency of the subsidiary. Then you come to the translation of these net assets. So you have your opening net asset, which is the 4 million, your post-acquisition profit, which is the 280, and then the closing net asset, which will be the 4280. And then you can determine your translation gain or loss. The exchange rate to apply: opening net asset at the opening rate, closing net asset at the closing rate, and the post-acquisition profit, which is a profit or loss item, at the average rate. If you apply them, your exchange or translation gain is 39.21. I'm pausing a bit for you to reflect on this and to think about what you did yourself and whether you were able to go through the procedure this way. If you don't, then you are getting it wrong. So this is the translation. You are to translate, but you must first determine the value of your net asset at acquisition and at reporting and the post-acquisition profit. Then you translate them. Goodwill, also in the functional currency, but you can tell that the purchase consideration was in Ghana cedi 763,600 Ghana. And yet you must calculate the goodwill in the functional currency, guys, in the functional currency. So you start by translating the 763.6 into the functional currency of CAF, and you multiply by 0.75, the acquisition date rate. When did they acquire? 1st January. What was the rate on 1st January? 7.5. We are translating the cost of investment to CAF, the functional currency. And so that gives you 5. Your fair value of NCI is in CAF, so 1 million. The net asset acquired is what you yourself calculated here, net asset at acquisition. Then you get your goodwill at acquisition, which is 50% impaired. And therefore, this is your goodwill at reporting. So you will now translate your goodwill at acquisition at the acquisition rate, your impairment being a profit and loss item at the average rate, and then the goodwill at the reporting date at the reporting rate. And that will then give you your translation gain or loss of 20.56. the share, which is the C part. The parent is 80%, so you take the gain of net asset translated, 39.21, and you shared 80%, 20%. And you take that of the goodwill, 80%, 20% NCI. And therefore, that will be 47.81 for the parent and 11.95. You take your question, you map it against this, and figure out where you went wrong, do the correction, and learn the lesson. Now let's look at question 2. In question 2, you were giving extras from the group financial statement and you were to prepare the movement in inventories, trade receivables, and trade receivable for inclusion in the group statement of cash flows. I don't know how you understood this question, but a lot of you really deviated from the way you were supposed to answer this question. Now, you are looking for the cash in working capital. Cash in working capital. And your working capital is your inventory, your receivables, and your payables. You want to extract the cash. You use your opening inventory. For example, if you want to go the T account way, let's say you want to do T account. So this is your inventory. It's an asset. And so your opening balance, which will be from 2019, your balance brought down on 2019 will be your opening balance, which is 265,100. Balance brought down 265,100. Then your balance carried down will be 373,350. Balance carried down 373,350. Then you come to the acquisition. In the year they acquired a subsidiary. Subsidiary was acquired and a subsidiary was disposed of. So the acquisition brought in inventory, brought in receivables, brought in payables. And the disposal will take out, we dispose of inventory, we dispose of receivable, we dispose of payables. So your acquisition will be an increase. The inventory will be an increase. So let's say acquisition will bring in 22,500, and your disposal will take out 34,000. Now you now strike the difference between these two balances. You can see that the credit side is higher than the debit side. So you have your cash balance here, which means you use cash to acquire more inventory. So there is increase in inventory. An increase in inventory means a reduction in cash because you have acquired more inventory. That is what this analysis means, because your total from your T account here is let's do it this way, 350 from the back, 704. So you have, no, let's do this again. 350 7 0, okay, 4. So you have 407 350. And so the difference here will be your cash out, because the inventory is increasing, and increase in inventory is cash outflow, because you are debiting inventory and you are credit cash. So cash is reducing, is a cash outflow. Let's look at this in the Excel. So this is your opening inventory, your acquisition inventory, your disposal, which will reduce the inventory. And so this is your total before the closing balance. And this is 253,600. If you compare it to your closing balance of 373,350, then you realize that you are increasing the inventory. Inventory is increasing. And once your movement is an increase in inventory, asset increasing, it means you are using cash to acquire more assets, and therefore it is a reduction in cash, a decrease in cash. So your asset increases, inventory increasing, and your cash is decreasing. And that difference is 119,750. 119,750. If you work it through the T account, you realize that this will give you 350, 7, 10, and 4. So that's how we are arriving at this figure. So this is our cash that we will report. The second is the receivable, and it will follow the same. Your opening receivable is 310, your closing receivable is 319, and then acquisition will bring in additional receivable of 39,500, and the disposal will take out, will reduce the receivable, and then you compare it, and then you find the difference as well. So the 310 opening, acquisition bringing in 39, disposal is 33. Here you can see that receivable is reducing. Your closing balance is 219, so your receivable is reducing, is a decrease, and a decrease means you are receiving cash in. It means you are selling inventory. Inventory is changing to cash. Inventory changing to cash and bringing in cash. Sorry, receivable. Receivable bringing in cash. So a decrease in receivable is a cash inflow. A decrease in receivable is a cash inflow. So this will bring in cash. And then in terms of the payable, your opening payable, payable being a liability, your opening payable, the acquisition will increase your payable, the disposal will reduce the payable, and so your net balance before the closing balance is 443. You can see that your payable is increasing. Your payable is increasing. It is a cash inflow. What it means is you are getting increase in liability, which means you are not using your cash, so you are retaining cash. So it is a cash in. It is a cash in, and that is 2460. You can do it this way, or you can do the T account. You have to do what works for you. You have to do what works for you. And the question 3, I required you to calculate the net gain on loss on monetary items. So you were just supposed to identify the monetary items and work on them. Some of you went and prepared the whole income statement. I don't need income statement. You only need the monetary item. And there were only 2, your cash and your liability, the loan. The loan. And also just to know how to translate. So you set out to know your cash balance, because if you don't know your cash balance, you cannot work out your monetary item gain or loss. And so you have to prepare a cash account or a cash statement where you identify cash in, cash receipt, and cash payment. And then the date the cash comes in and out, you use those dates and determine the conversion factor, the index for those dates, and use it to convert the cash into the CPP index. And that was what was required. Some of you went and prepared the whole income statement. Please take note of the requirement, and it only shows that you do not understand the question you are supposed to answer. Calculate the net gain or loss on monetary item is different from translate the income statement, translate statement of financial position. There are two different requirements. This is just the monetary items. So you have to look for all monetary items in the form of receivable, cash, loans, and then you translate them. Okay, so this is how that will look. You prepare the first one, your cash. And so you identify your cash in the historical amounts, and then your CPP factor using the date the cash came in. So you have your cash receipt, the capital that was raised brought in cash, the loan that was contracted in March brought in cash, and then they made sales which brought in cash. So you identify these and the appropriate factor. First of all, the factor is the closing factor, the reporting date factor over the date of entry. And so 31st December year-end reporting date is 180. And then you identify the date of entry of each of the items. This is January at the beginning of the year. This is in March. And this is sales. So we are using the average. Then the payments that were made. The entity acquired warehouse and it acquired it 1st January, beginning of the year. The inventory was acquired 1st January, beginning of the year. The expenses are profit and loss item. We use the average index. And therefore, you translate, and that's your historical monetary, your cash balance. And this is your CPP cash balance. So you deduct the historical from it, and then you determine the loss. It's a loss on holding cash. And you compare this with the gain on the loan. The loan, look at the loan. The loan came in March. And so the historical loan is 720 and the CPP loan is 926. And therefore there is a gain of 206, which will give you a net loss on holding cash of 690. So this is how you are supposed to present the thing. If you do not present it this way, Wati, this is how you are supposed to be presenting your solution. If you do not present it this way, then you understand why you have performed poorly. Use this, pause the video at short intervals and look at what you have done and use it to revise for your exams. Thank you.